Hello and welcome to today's edition of Beyond Reasonable Doubt. Again, my name is George Wong. Today we shall be looking at the types of insurance. For those who have been following, we started the series of Beyond Reasonable Doubt by looking at the history of insurance, then followed with an episode on the concept and purpose of insurance. The last episode we were looking at the risks of insurance, and today we'll look at types of insurance. Just a reminder again, this September is Life Insurance Awareness Month. So let's look at the kind of insurance that we have in existence in the insurance industry. For the previous episodes, we focused or we generalized the concept of insurance just to make sure that in the Life Insurance Awareness Month, we explain and understand the concept of pooling and spreading the risk into a bigger pool, a larger community, in order to reduce the burden on participant individuals. So, however, now we're going to shift our focus to life insurance because this is Life Insurance Awareness Month. The insurance industry is pretty big and we're not going to cover everything insurance. So our focus now will be on insurance. However, we may have to make mention of other types of insurance if the discussion brings value to the discussion. So before I get into it, I like to make this point very clear. Life insurance, what is the meaning of life insurance to you? There are some misconceptions around this. Life insurance, some people think that any kind of life insurance is permanent, is there for life. The meaning of the life insurance does not mean that you have it for the rest of your life. It just means that it's an insurance over your life in case you die. The death benefit will be paid to your beneficiary that is left behind. It could be temporal for a short term. It could be permanent. So watch out for that, and if you have questions regarding this, don't hesitate to put in the comment section and I will be glad to answer them. So let's get into it. So talking about types of life insurance, basically when it comes to life insurance, there is just two types. To be very simplified, there is just two types. It's a term insurance or temporary insurance, temporary life insurance, or permanent life insurance. I just put here some examples, but there are not types. There's only two types: temporary life insurance and permanent life insurance. So for temporary life insurance, as the name implies, this is designed to protect the risk of some temporary risks. For example, if you take a student loan or other kinds of loan for a short period of time, say 10 years, you don't need to buy a life insurance for your entire life to pay just for that loan. Or you have a mortgage, for example, for 25-year to 30-year period, amortization period. So you can take a 20-year term 20, or a 30-year term 30. So those are all examples of temporary insurance, and also examples of needs, the kind of risks that are temporary that you would need the term insurance. But however, there are some financial needs, like considering your funeral expenses, or maybe you build your assets over your lifetime and you want to protect them. Estate planning, you want to make sure that your assets are properly distributed according to your wish to your family. Then you want to start putting those needs into a long-term, permanent life insurance. And we will get to discuss this in much more detail in the upcoming episodes. But to keep things simple here, types of life insurance is only two: temporary life insurance, permanent life insurance. I hope this one is pretty clear here. Temporary covers temporary needs, and permanent covers permanent needs. You cannot buy a lot of life insurance that is going to cost you a lot for the rest of your life when the need is only temporary. Like a mortgage is 25 years, it's not 100-year period. So just an example for that. I need to mention here that picking a 10-year term, 20-year term, 30-year term is just a matter of cost. For the same amount of insurance, if you pick a 10-year term, the cost is much smaller. If you pick a 20-year term, it's much bigger than the 10-year but smaller than the 30-year. But however, if the risk is a risk that will last a longer period, like 30 years, it might be cheaper for you long term to buy a 30-year term insurance rather than buying a 10-year term insurance, because when it expires, you have to maybe renew it or buy a new one. By then you get older and the cost is still going to go up anyway. So you really want to buy a 10-year term only for a need that you know that the need will disappear in a 10-year period. If it goes beyond that, it's cheaper for you to buy a 20-year term rather than buying a 10-year term. So think of it as those of you who are used to those business terms, buying wholesale versus buying in retail. Buying in retail, you may just need only a couple of units, so you don't want to spend much, so you just buy the smaller unit. But if you buy in bulk, though you buy a lot, you spend more, but over time you save a lot of money, because if you buy in retail, when the need comes around again, you go to buy, you end up spending more. So think of it that way. So by extension, it's a way of saying that term insurance may be cheap, but it comes down to the need, the risk, how long is the risk going to be there. If it's a longer term, you may even consider putting it as a permanent need. Just buy a permanent insurance than to buy the term insurance, because buying a permanent insurance, it's going to cost you in the short term a higher expense, but long term, because it's a long term need, you're going to save a lot more. It's very cheap. The difference is very significant. And just a side note to know that term insurances by law, they expire at a certain age. 71 is the general average. Some companies draw it a little bit further, but the design for this contract was for short-term needs, so it was not meant to be permanent. So at a certain point, beyond 71 years, if you have not gotten insurance, you cannot buy term insurance, because by law is very expensive, and they call it prohibitively expensive. So it doesn't make sense at that point. So it's not serving the purpose of the customer. In other words, if you have a term insurance, there is possibility for you to convert it into a permanent over time. So maybe for the reasons of cost or affordability, you start with a term insurance, but you know you have that need there, and when things get better financially, you want to convert it as soon as you can to a permanent insurance, because the longer you keep it, it's going to cost you a lot more. And before 71, if you have not converted to permanent, you cannot buy a permanent temporary insurance beyond that age. And at the same time, it's even unthinkable to think of buying a permanent insurance. The only feasibility, maybe if you already have a term insurance, you want to convert that one to permanent. Seeking a permanent insurance beyond the retirement age of 65 to 71, that is unthinkable. As I mentioned earlier, there are many examples of temporary insurances, and because we are focusing on life insurance, I brought these examples here just to draw the distinction so that you understand. A lot of people in our communities, they see need because they do businesses, A lot of businesses are booming around since COVID. Independent or self-employed business owners, so they come across this type of insurances. So I deem it necessary to include it here to separate, to make the clarity or the difference between temporary life insurance and other temporary insurances. Most insurances are temporary because the needs are temporary, like most of the business insurances. Uh, these are other examples of temporary insurance. A term life insurance is a temporary insurance. Critical illness is a temporary insurance. And to make this distinction, this is not a life insurance. Just so you know, disability insurance as well is a temporary insurance. The need is temporary. Uh, for example, if you are working in a very high risk job, for example, in construction or in aviation, you need this insurance for as long as you're there. The need is only for that period. Accident and sickness is another example of a temporary insurance. It's not permanent. Professional liability, business, commercial insurance, commercial property insurance, home insurance, auto insurance, these are all examples of temporary insurance. But however, we're not going to focus on them because they are not life insurances. They don't insure the life of a person. They're insuring a property, a business, or something of that. So I thought of a better way to make the distinction between temporary and permanent insurances. So I put some of these criteria together so that because I believe this may bring some more clarity, more understanding on the differences between them. So when it comes to death benefit, for example, within a term insurance, except you die within that term, if it's a 10-year term, for example, you can only benefit from it if you die within that 10-year period, and then your beneficiary will claim it. For a permanent insurance, regardless of when you pass away, it will be paid. So it's a guaranteed lifetime death benefit. When it comes to cash value withdrawals, there is no cash value in the term insurance in the first place. In the permanent life insurance, yes, it's possible, and you can withdraw while you're still alive. And if you pass away, the death benefit will be paid. So either way. So can you add a protection? Possibility of adding a protection on a term insurance is no. On a permanent insurance, yes. If you buy a permanent life insurance plan, you can add another term insurance on it for some temporary risk or a critical illness, and so on and so forth, some like a rider. Flexible premium. The term insurance premium is fixed, it's not flexible. With permanent insurance, there is some flexibility above a certain minimum. There is some flexibility. So when it comes to cost, term insurance is cheap within a short-term period, but on the long term is the most expensive product because it's not designed to be long-term, by the way. And I mentioned this again, though I already mentioned, because some people tend to buy insurance, they don't know it's a temporary insurance, and they feel that it is insurance for life, and then it will end up costing you, and they will give up along the way after spending a lot on it. In a permanent insurance, in the short term, the cost can be high, but long term is very, very cheap. Very, very cheap. So consider your needs before you request the kind of insurance that you're requesting. So for investment, there is no possibility of investment in a temporary insurance, but in a permanent insurance, yes, you can invest. The percentage of claim, just to give you a perspective. Temporary insurance, if I'll put this as a question, if life expectancy in Canada is between 83 to 85 years, and all term insurances, they come to an end by age 71, what is the chance of dying before 71 if the average life expectancy is between 83 to 85. It's very, very slim that somebody will pass away before 71. So it's almost a guarantee that a term insurance will not be paid. The claim will not be paid. So this is a way to clarify some of the misconceptions when some people think that insurance they don't pay out claims. Of course, if you outlive your term, you buy a term insurance and you outlive that term, it will, how do I put it? It will be obsolete. It will be obsolete. So you don't have any insurance. It will expire in or whatever better word you can. So claim percentage for term insurance is approximately 3%. So think of it this way, out of 100 people that buy temporary insurance, only 3% of them manage to die within the term and that they can make a claim. Only 3%. The rest of the 97% goes to the insurance company. On the other side, for permanent life insurance, approximately 97%. These are statistics, by the way, from the insurance companies themselves. Some of them you can go on the website and you find them. They should be publicly available information. So permanent insurance, it should normally be 100% because it's guaranteed lifetime payment. If it comes down to 97%, it's just because of the fact that, yeah, some people may die for some other reasons, which maybe for reasons that were excluded. They may have some exclusions within their policy, which I try to make a mention of exclusions, non-insurable risk, for those of you who followed along when we were talking about risk. So if you have those exclusions, of course, those will not be paid. If you pass away as a result of those pre-existing conditions, which were not part of the contract, of course, it just makes sense that they will not be paid. Or you commit suicide and some other things that I don't want to go into those details, but just for your understanding, that's the only reason that can make the percentage drop from 100%. Otherwise, everybody that has permanent insurance is guaranteed to pay the death benefit. As a summary for today's topic, here are some takeaways. Again, life insurance means insuring your life. It does not mean insurance for life. It's not insurance for your whole life. It could be if it's permanent, but it is not if it is temporary. So life insurance just simply means insuring your life. It doesn't mean you have insurance for the rest of your life. So permanent insurance means insuring your life for life. It is insurance over your life for the rest of your life. And a term insurance protects short-term needs. Those are some takeaways from today's topic. And I have some questions for you before our next episode. If you can answer these questions, put in the comments just as a way to engage you and the others who are following us along. So, does home insurance pay out when you pass away? In other words, does home insurance pay out on your life if you pass away? Does critical illness insurance pay when you have an accident? Does a life insurance pay when you survive an accident? So if you have an accident and you survive, does a life insurance pay? Does critical illness pay a death benefit? Those are some questions for you to go and test your understanding of insurance. At this moment, I want to thank you for watching, and I continue to be with you. We appreciate your coming here. Like, if you followed along and you like what you heard here, click on the like button and I think it can help some people as well if you can share. And very important, if you like to continue getting notifications for upcoming episodes and other videos, it might help you to subscribe, and we will appreciate if you subscribe to the channel so that you will get notified each time a new episode is put up. Thank you for watching, and watch out for the next episode. In our next topic, we shall be talking about the cost of insurance. Thank you.